and let me start sharing my screen. Okay, can everyone see my slides?
I can.
Good, brilliant. Okay, if you can, Pete, everyone can. Perfect. All right, welcome. Welcome to SCORE Minnesota's webinar, Buying, Selling, Exiting a Business. We've put together an amazing team of experienced professionals who'll be sharing their wisdom with you today. Before we get started with the webinar, I'd like to tell you a little bit about SCORE Minnesota and the resources that we offer. Firstly, SCORE is a nationwide nonprofit organization supported by the Small Business Administration, or the SBA. We provide businesses with free, confidential business mentoring, and lately that has been done primarily through, lately that has been primarily done through webinars and Zoom meetings. Our chapter, the SCORE Minnesota chapter, has nearly 90 volunteers serving Manatee and Sarasota counties, and we have been doing that for over 50 years. And recently, our chapter has been recognized as a Diamond Chapter of Excellence, which is the highest award that a chapter can receive. Since its founding, Since its founding in 1964, SCORE has assisted over 11 million clients. We help businesses in all aspects of a business, from pre-startups, and many of our clients come to us with an idea and we have to help work them through that. Often they are opening a business and need some startup plans, or they're growing a business, or in the case of our presentation today, they're selling or closing a business. I'm sorry, a doctor's office is trying to reach me very badly. Okay, so we recommend that you go to our website, minnesota.score.org, and check out the resources that are available there. You can request a mentor if you're in business and need some help. You can find a webinar or a workshop. You can locate a podcast or look for more resources in our libraries. Lastly, I'd like to thank our sponsors and community partners. These are the folks that help us keep the lights on. If you have an opportunity to support any of these organizations, let them know that you saw that they are supporting SCORE and thank them for that. Without further ado, we're going to start our webinar, Buying/Selling/Exiting a Business. And the first thing that we're going to do is find out who exactly is on the exit strategy team. So Peter, if you don't mind, could you introduce your fellow presenters?
Good afternoon, and we're happy to have you with us. One of the purposes of today is to give you an idea of what our backgrounds are as SCORE mentors in general, and to encourage you to get a SCORE mentor who's going to help you through the details of this. So we look forward to hearing from you on that regard. Missing in action right now because he's having some technical difficulties is Dennis Zink. Dennis, as you can see from his profile, has been a real motivating force of our chapter. He's been the former, oh, he's here, Dennis is here. Dennis, you want to come on board? Turn on? Well, wherever. And then in addition to Dennis, we have Jory Berkowitz, I always say Berkowitz. Jory is a SCORE mentor as well and is part of the exit strategy team. And Jory has been in the financial services business for a very long time and is retired from that. He's also a great author. I've read both of his books and I found them to be very interesting and really right on. And he has a lot to share in reference to what people go through as far as their quest for running their business. In addition to Jory and Dennis, we have Michael Zuckerman. And Mike has spent 50 years plus years in the legal profession in upper state New York. and he has been responsible for estate planning. He's just a myriad of stories and experiences in reference to what it takes to sell or buy a business or partnership relationships. We count on Mike to keep us on the straight and narrow in reference to what we can do and what we suggest. Mike, myself, Jory, and Dennis are all subject matter experts within SCORE, and your mentors can participate and call us in to help you with either buying or selling a business. And we're very happy to do that. My background is I'm in real estate, and I've been also in the software business, and I participate and I've managed some fair-sized businesses, and that's where it's at. So that's where we're at. So that's the story. So Dennis says if we can't hear him, which I don't think we can, maybe he didn't put his mute button off. Dennis, you come on anytime if you want to. But remember, when you're talking about buying or selling a business, there are always two sides of that coin. One is the buy side and the other is the sell side. And you have to understand when you're negotiating to sell your business, when you're negotiating to buy a business, it isn't just up to you. There's the other side of the coin that has to be determined, and you have to meet those requirements on both sides to, in effect, get a positive deal. Okay, next. So an exit strategy is really important for someone who's thinking about retiring, selling their business, passing their business on. And it's very important because everybody eventually exits their business. And so the purpose of today's meeting is to discuss what choices you have in exiting that business. Most people don't take the time to develop that choice. And as a result of it, they're buyout sufferers, or the purchase, they may pay too much, they may not have anticipated something. And that's the purpose of today, to kind of get a feel for what it is you have to do to prepare for an exit or to prepare for a purchase. And that's what we're going to talk about. Diane? So the question is buy or sell. And both, as they say, they both have sides of the coin. One of the things that I have done in my mentoring and in a number of presentations we've made before is we've talked to people about what is the amount I need to fill out on this check for you to give me the keys and walk away. And if you're thinking of selling your business, that is an option that happens. Someone will walk into your store or your shop or wherever it happens to be and say, okay, I'm interested in buying your business. How much do you want for it? And I know that is very crass and it's kind of, you're right on top of it. The problem is those are opportunities where you have to have something in mind. You have to be able to determine really what is your going price. In some of the meetings, I'll say, okay, I want people to raise their hand if they're willing to accept $100,000 and give me the keys. Well, obviously, no one in that audience has thought about this. And so nobody raises their hand at $100,000. Well, what about if I gave you if I wrote the check for $200,000, how many of you would be willing to give me the keys? And we don't get any then. When we hit 300,000, it seems the people in the audience all think that's a reasonable number. And so we'll get them to raise their hands under those circumstances. Sometimes it takes a little bit more than that. So the question to you, if you're thinking of selling your business or exiting your business, what do you need someone to write a check for to give them the keys? Dan? So the quiz is, when is the best time to sell your business? When you're tired of operating your business? When you're losing money? or when you have lots of money in the bank, or when you're profitable? Diane? What factor is the most important impact on your business value? This is one that you can all you could chat me on this one if you want. And that is what you think your business is worth. I think my business is worth, I don't know, it's 300,000, 400,000. But what is that important? It is. The amount of money you have in bank loans or other debt, is that what you determine your value by? I mean, a bank had to prove those. What about the gross sales of your business? Is that what is important for setting the value of your business? How about the profits your business generates after you've bought a car for your son and those kind of things? Or the number of employees you have. So everybody, it's the profits your business generates. All of these other things are very variable. They all represent different values to different people. But the bottom line is, if you're going to sell a business or if you're going to buy a business, you have to determine what the profitability of that business is for the past and what you project it to be for the future. So everyone will exit at some point. How you exit, planned or unplanned. We talked about that before. And that's very important for you to anticipate how you're going to cash out of this business, or are you going to do it? Are you going to walk in with an open check and write a check to buy something? Or are you going to just say, well, I'll take $300,000 without really realizing all the other things that go with it? The hard part of this decision in exiting a business is to determine what the value really is and determine what the customer is buying. If you're selling a business, you have to know what you're selling, and it could include all the art on the wall. Or you may think it just includes a couple of different assets. We're going to talk about that throughout the presentation. So what are the reasons for selling? We call these the dismal Ds. Well, death, of course. You really don't care if you're dead, but your heirs do. A divorce, declining sales, that's a real reason. Many people do. Declining health, that's also something we run into a lot. Or dissension among partners. All of these terrible Ds are the things that really occur when someone looks to make a decision to sell their business. And you have to try to make a decision about selling or buying a business based on these risks. That's what they are. They're the risk of operation, the risk of value. That's what you have to watch out for. So Dennis would talk about this. Dennis,
can you hear me all right?
No, there you are, Dennis.
Okay.
Put your video on and take over.
Well, I put video on, but it says I can't because the host has stopped it. So I don't know if Diane can get me video. So
yeah, let's do it without video.
Okay, let's do it without video. Peter, you're doing a great job.
Well, not as good as you would have done, Dennis.
Well, better late than never. Anyway, so when is the best time to sell and when is the best time to buy? We like to look at the Adizes corporate life cycle curve, which kind of shows a business from birth to death and everywhere in between. So the best time to sell is when your business is doing the best it can be doing, and we call that prime. And that means you're making money hand over fist. Your business is growing rapidly. Everything's humming along smoothly like a well-tuned engine. So that's the best time. If you wait too long and you start going downhill, then you're not going to get as much money as you would when you're in prime. And you can stay in prime for years, even decades. And so that's your goal, should be to get to prime and then sell when things are going really, really, really well. Next slide, please. So the steps in the buying process. So the question is, what is your business valuation? There's a very distinct formula that always never fails. And really, it's a formula for valuing your business. And what it says basically is that, next slide, is that your business is worth exactly, no more, no less, what a willing buyer is willing to pay and you're willing to accept without any, without a gun to your head. So no more, no less. So unless there's agreement, there's not going to be a deal. Next slide, please. Jory, this goes to you.
Okay, thank you, Dennis. How long does it take to sell a business? Like many of the issues that we'll discuss this lunchtime, I guess, there's no simple answer. There's no simple answer to selling or buying a business or negotiating or valuing a business. And in this case, when I first looked at this, I said, that's very interesting. And for some reason, the numbers added up to 99% instead of 100. And I said, well, that's okay. But I did a little more digging and I found out that 80% of all businesses that are put up for sale don't sell. So what you're looking at is 20% of the businesses that somebody's trying to sell actually get sold. And of those folks, the average time period is somewhere around a half a year. So it's not easy to sell. Obviously, most deals don't get done. And that's why it's really imperative to plan in advance and learn as much as you can about the process before you go ahead and try and market your business. After all, it's more than likely the most important investment you have made in your life. And this transaction will be one of the most important transactions of your life. Next slide. Okay, this is kind of a busy slide, and it's okay. Steps in the selling process: buyer responds to ad, and then the seller contacts the buyer without revealing his identity, and then the interested buyer signs a confidentiality agreement, and you meet with a buyer in a neutral location. Are these bad ideas? No, not at all. But it's just one set of possibilities. For example, if the buyer is your cousin or your partner, you know who he is. There's no reason at this point for meeting in a neutral location. All of this is known. So what I'm trying to say is this is one possible outcome, but every transaction is unique. Next slide. Now, Dennis joined our call just in time to see his name in print, and again, his picture. But if you read the Herald Tribune, Dennis has been writing a column in the business section. I believe it appears every Monday for a number of years. And one of his most valuable was 6 strategies to use to exit your business. And reprints of this article are available to anybody who's interested. Next slide, please. Okay, so I'll cover a few of them. They have the same format, really. Good news and bad news. Every one of them has good news and bad news. Strategy number 1 is the fire sale, desperation sale. It's fast, and if you hate it that much, I guess the good news, you don't have to worry about your business anymore, but it's of all the alternatives, probably the worst thing that you can do. Next slide. Sell to a third party. This requires the most preparation, the most negotiation, the most question, energy, time, effort, etc. And it takes a lot of time when you're selling to a third party. But in the end, you may well be getting the best result, the best selling price from strategy number 2. Next slide is selling to your business partners. It's kind of funny. The good news is they're familiar with your business, and the bad news is they're familiar with the business. And I suppose you could say the same would go for family members as well. There's some more complications associated with that. But this is something that obviously you don't have to think about if you don't have a partnership. If you're the sole owner, you'll have to look in some of the other strategies to exit. Okay, next slide. And Pete.
Thank you, Jory. The issue, the number two, selling out in the marketplace is very difficult. Probably the most success we have seen, I have personally seen, in reference to businesses selling to somebody, is selling to a competitor. You say, well, then, why would I do that? The point is the competitor understands the overall market. The competitor, if you are smart in selling your business, you will have learned how your best potential competitor to buy your business operates their business, and you would begin to profile the way you do business the same way your competitor does. And when they come in to evaluate the business, they say, well, gee, this is like picking up a branch. This is great. This is what we want to do. So you have to use some logic in reference to who you're going to sell to. So a competitor is familiar with your industry, certainly, and may to them offer all kinds of economies of scale to the buyer. The other thing that happens, if your competitor is a public company, your business is worth more to them than it is to you because of the multiples that a private business gets and that a public business gets. Public businesses, run 20 to 30 times earnings. A private business, you're talking about maybe 3 times earnings. So that's really it. The other problem is if you don't close this deal, your competitor knows how to pick your bones, and you don't want anybody picking your bones. This is a very dangerous thing to sell your business. If you are a competitor and you want to buy somebody's business, you hope that they haven't prepared well, because they'll just accept just about anything. Let's go to the next one, Diane. Now, we see this a lot. I want to sell this to my employees. My employees are the best people on earth. They have worked with me forever, and they really are good folks, and I want to do everything I can to help them. Well, the biggest problem is, do they have the financial capacity to do it? Many people, when they sell their businesses, are selling their business to fund their retirement. And if you're selling your business to somebody as a gift, you better have a pretty strong retirement. Also, is there a strong first or second person in charge right now who you can sell it to? You don't want to sell your business to the village idiot. Because, why? They have to make it work. Many different purchases of businesses have to rely on cash flow to make sure they make all the payments. Most of the time, when somebody is going to buy a business, they want to get paid back the money they paid for the business out of the cash flow in 5 years or less. And you have to think about that. That's how you leverage the opportunity. So selling to an employee is a good idea if your employee doesn't come to you and ask you what you have to do next. And you really have to look for the right personality for it. Diane? Now, this is one that Michael will talk about a little later on in the presentation. And this is something everybody thinks about. I'm either going to sell it or I'm going to gift it to a family member. Now, if you think selling to another entity is difficult, depending on the family dynamics, this could be selling into a rat's nest. So you have to really know who's interested in the business. We've come across people who say, I'm going to give the business to my son. Well, let's ask the son a couple questions. And he says, what? I saw what my dad had to go through. I don't want anything to do with that. Dennis and I went and talked to a lady who had a very nice business. She inherited it from her mom and dad, and she'd been running it for like 15, 20 years. And she wanted to leave it to her kids. They wanted nothing to do with it. She wanted to get her two brothers to participate in it. They didn't want anything to do with it. She didn't really know what she was going to do and had to go through this whole process that you're looking at today to get an understanding of what the business was even worth. So I encourage you, the offset of this is as a result of seeing this presentation. You're not going to just push a button and everything will happen for you. We recommend that you get a free, confidential, and experienced mentor from SCORE. They don't cost you anything, and their advice is usually pretty good. And they're confidential and they're free. So why wouldn't you take advantage of that if you're thinking to do something as big as this in your life? You want to have the best advice you can get before you go forward on one of those things. So that's where we're at. Dennis, are you still with us?
I am.
Okay.
Thank you, Peter.
Yeah.
In fact, Peter mentioned the person with the business. We saw several people. It was a Walk Bradenton initiative with the County of Manatee and the Manatee Chamber of Commerce. And we walked into dozens of businesses, and many of them just had no clue of what to do with their business. Their kids didn't want it, as Peter said. They had no idea. So that's what Peter and I had lunch after, and we decided to start this program on the exit strategy imperative and to help businesses understand and guide them through this process because they're not familiar with it. When have you sold your business before? Chances are you probably haven't. So we found some very interesting statistics with Forbes magazine. People think things are forever. You get married forever, you have your business forever. Well, that's not really the case. But if it's a family business, if it's passed on, 90% of all businesses in the United States are family owned or controlled. I mean, it's hard to believe that's such a high number, but if you think about it, it makes sense. They generate over half the GNP, the gross national product. And yet only 33% survive transition from a first to second generation. A friend of mine wanted to sell his business, or not sell, give his business to his kids. I said, do they want it? Has he ever shown any initiative? Has he come to your business? Has he tried to learn or ask what you do and why this is something I should be involved with? No, he's not interested. I said, be fortunate that you can sell the business for a lot of money and then provide him with a new start by giving him the money he needs to do whatever he wants. And another 50% don't survive the transition from a second to a third generation. It's only about 14%. So if you're thinking about passing your business on through family, it isn't a great idea. And only 3% operate in the fourth generation. So you're much better off selling your business to a third party. Next, please. So what's the best strategy for you? Initially, we wanted to do this as some of these as quizzes that we could respond to. We'll do that the next time we do this. But some people, as we went through the 6 strategies, they just want out. I mean, I hate my business, or I just want to be done with it. Selling to a third party is typically going to get you the most money. Selling to your business partner, that could be a good thing or a bad thing, as we look back in the last slides that Jory went through. Selling to your competitor, your employees, or gifting. So we went through all those. Next one, please. So here's some more interesting statistics. I couldn't believe we have over 200 people online today for this. This is fantastic turnout. And of course, there's got to be some interest in selling your business now or in the future. So realizing that a lot of your net worth is tied up in your business. I mean, 80% of financial assets most people have are tied into their business. So you better make the right decision when it comes time to sell it. 2/3 of the business owners will likely sell over the next 10 to 15 years. So there's tons of businesses coming on the market, which again, for the flip side of the coin, if you're a buyer and if you're on this webinar today because you're interested in buying a business, then just look at the information from the other side. But there's going to be tons of business coming online, and you really can pick and choose and get something that fits with your lifestyle and what you want to accomplish, your goals. 53% have given little to no attention to their transition plan. So congratulations being on this call today. At least you're thinking about it. And 2/3 of the people agreed that getting full value to fund their retirement was their top goal. Most business owners don't have a good idea of the value of their business. Next, please. So what happens when a deal's consummated? How does a deal get consummated? So typically, as Peter mentioned, multiples are much lower in closely held businesses, usually typically 2 to 3, could go as high as maybe 7. Rare that it would be more than that. In the public domain, it could be in the 20s or even 30s as a multiple. So what happens is there's an agreed upon multiple, usually based with your most recent year's profits. Sure, a buyer will look at the last several years, they'll look at your tax returns, they'll look at your financials, and they'll want to see what the direction, what the trend of the business has been. Obviously, an uptrend is better than a downtrend or a flat trend. So, but a buyer is interesting in what the business is going to do for them when they buy it. They don't care that much really about what you did last year or the year before, other than how profitable you were. They want to know, hey, I'm going to buy this business. What can I do with it? How am I going to succeed? How am I going to do things maybe differently than the last owner and make it more profitable? Maybe I can scale this business. Maybe there's more units I can put out into different markets. So a seller wants to sell the past and receive compensation for the future profits and prospects of the business. So what do I mean by that? The seller saying, well, here's my financials, but look what it's going to do. This business is going uphill. It's going to have a great year the next year or two. And so I want my multiple based on what it's going to do. And then the buyer says, well, wait a second. I'm buying what you did. What it's going to do is under me when I buy it, when I take it over. So why would I pay you for the future profits? And then they say, hey, look, let's work a deal out. Let's work a deal where there's an earnout, and we'll pay you on some of the future success if you stay in it for a period of time using an earnout. And if you hit these goals, then we'll pay you a little more. So basically, a deal gets consummated when both parties agree, usually somewhere between the buyer's and seller's price, and often at a multiple that's common to the industry. Next, please. This goes to Jory.
Oh, yes. Okay. Since here, we've talked a little bit about multiples of cash flow or multiples of earnings for to consummate a transaction. And there's a lot of different reasons that the multiples in the small business market, privately owned business market, are much, much lower than the public markets. Some of it is simply the issue of liquidity. If the owner of a retail store in downtown Sarasota wants to sell, he can't call his broker up at 10:30 in the morning and say, get me out. It's not that easy. So it's obvious that because of the difficulty in completing a transaction, that the multiples are going to be lower. The other thing is that, and it's not the case for every businesses, but privately held businesses tend to be a little bit more pedestrian than publicly held businesses. All things being equal, if you had two businesses and one was a neighborhood shoe repair store and the other one was Zoom video, it's clear what business is growing faster and what would demand a higher multiple in the transaction. So there's many different factors to keep in mind. Next, Diane. We kind of touched on this. As the owner, you must remain in control of the business until you have received full value. No. If you sell a business on an installment sale, it's sold. You don't own it anymore, but you're going to get your proceeds from the sale over time. Many owners would prefer that, particularly if they're selling to fund retirement. They might take a payout over 3 years, 5 years, 7 years, even longer. So that's clearly false. Next slide. Well, we took the blank one out. Next time we'll put it in. We had a blank slide in here, and I kind of liked it because that's how you have to start thinking about planning to purchase a business or run a business or sell a business, which is with a blank canvas. At SCORE, we started using something called a business model canvas to help us and our clients supervise an existing business to make it run more effectively and efficiently. And with the business model canvas, you start out with these boxes, as you see, but they're all blank. And the owner has to fill in the various boxes and refine it. It's sort of like a business plan or a sales plan on one page. Same principle would apply to selling your business, or the flip side would be purchasing a business. In this case, we're talking about a make-believe pizza business in New York City. So what's written in the boxes is something that really is just for illustrative purposes. But you do want to look at the headings there, the background of the business, what's triggering the sale, the strategy that the owner would need to utilize to make an effective sale, where his business is in the lifestyle that Dennis spoke about earlier, valuation, due diligence, competition, etc. So you can look at this and take it for what it is, a make-believe strategy for a make-believe company, but you can definitely use this for yourself. And it's something I don't think you can do enough of to make sure you put your business in the best possible light when you're approaching the time when you want to list it for sale. Next. So here we're talking again about valuation. And as I've said a number of times, this is not a cookie cutter formula that you can use for any business. Cash flow or EBITDA, and they're both pretty close, are essential if you want to sell a business and to interest a buyer to get active in the business, because if a business doesn't have any cash flow, doesn't make any money, nobody's going to buy it. So that's really a starting point. The applicable multiple is the variable. And there are many different things that would affect that multiple of earnings. And so here we see some of them. Sales of comparable businesses is sort of like the Zillow approach to finding out the value of your company, assuming your margins are comparable and your growth is comparable and your customer satisfaction is comparable and your online reviews are comparable. Then I suppose looking at a comparable business would give you a fairly good start at valuing your business in terms of its ultimately selling price. Other things you need to consider are owner perks. Some businesses, in fact, all businesses, I think, that are private, are run to minimize reported profits, because that means the owner is paying less in taxes. Much different for a public company that wants to maximize the earnings that it reports, because it's going to help the stock price. So you have to keep all of this in mind before you go forward. Next. And I'm going to turn this over to
Hi, can you hear me?
Mike. Yeah, Mike. Okay.
Am I on now?
Yes, Mike.
All right, so now we'll talk about, you're thinking about buying or selling a business. And the first advice I can give you is don't think that you can do it on your own. Just say, oh, I've been in business for a while. I know what I'm doing. Why should I pay someone else when I can do this myself? Well, if you don't pay them now, you'll pay a lot more later, I can assure you. It's very important to assemble a team to get together to decide how you're going to buy, the best way to do it, and how you're going to approach it. I suggest that there are possibly 4 different groups that you should assemble on your team. The first one I would go to, and again, we're prejudiced, but is the score. Because for us, having been through this so many times ourselves and giving free advice, we can get you on the right track as to the best thing. We can get you what information you need to accumulate, what you should talk to your attorney and accountant about, and what have you. So that's extremely important. The broker is if you're going to sell to someone who's outside and is not really, you don't know who they are, you could use the broker. But I can tell you another thing, and I hope I don't antagonize any brokers, but use them to find your buyer or your seller, but then leave it. They're going to tell you that, oh, I've got an agreement that's just perfect for you. We could use that. Why pay an attorney? I'll give you this. Remember that the broker's only interest is completing the deal, not for your best interest. So get yourself a good attorney and a good accountant. And when I mean a good one, I mean someone who's experienced in the field of buying and or selling the business. You don't want to go to a divorce lawyer who's never handled an account and have him try to handle it for you. Please, that's very, very important. And the other thing that's very important is to make sure you avoid any conflict of interest. You go to this person, you say, I'm thinking of buying your business. Oh, I've got a wonderful lawyer. Why don't we have him represent both of us? Or have an accountant who knows the business. Why don't we represent both of us? Because it's impossible to represent both of you. There are questions that have come up that are particular to you, and you need your own separate representation. So that's what I can tell you best about that. Next slide. Once you've gotten to the point where you decided to buy the business, you've gotten your accountant, your lawyer, and what have you, it's important to get a letter of intent. Now, this letter of intent, of course, only applies to a sale or a purchase from an outsider. Next slide. If you're selling or giving to a family member or employee, you should have a letter of understanding so everybody knows what you're expecting, how they're going to do it, and what's involved. If you're dealing with a partner or a fellow shareholder, it's extremely important that you look at your operating agreement if it's an LLC, or your shareholders agreement if you're a corporation. One of the biggest problems that people have coming to SCORE is having a representative, a client who comes in and says, I've got a partner, I've got a shareholder. What are we going to do? How do I get rid of him? We've been together 20 years and suddenly we don't see eye to eye. How do we break up? And I say, well, let's look at your operating agreement or your shareholders agreement. And they say, oh, either we don't have one or we had one we took off the internet that was done by LegalZoom or something, and it really doesn't cover that situation. So really, if you do nothing else, if you leave today, you have a partner or a co-sharer or co-owner, make sure that you have a buy-sell agreement represent all there and make sure it's up to date and workable and it's fair to both of you. I can't give you enough advice on that. Now, go stay back at the other one, please. The letter of intent is prepared by the buyer. And the reason that is that it's usually the buyer's attorney who prepares it. And the reason it's prepared by the buyer is the buyer knows exactly what it is that the buyer should have in order to make sure they're buying what they think they're buying. So the first thing in the letter of intent is whether it's a purchase of a stock or assets. Now this is hugely important. We'll get into this in the next slide, but so that would say we're doing either stock or we're buying certain assets. The second thing that in the letter of intent is how you decide on the purchase price. It's rare that you would give an exact number, but you would probably give some kind of a number plus a method of either altering or determining that price. Next, you talk about what are the terms of employment. Is the seller going to stay on for some period, consult, non-compete, that should all be listed. And what about retaining employees? That should be talked about because people are very sensitive about making sure their employees have a decent chance of remaining, and they don't want to sell the business out of it. Provisions for due diligence, and due diligence we're going to talk about later, but again, you should provide how that's going to be done and when it's going to be done. The timing of the transaction, including the date when the letter expires, if not accepted. You can't leave a letter out there and have them go shopping around and finding someone else for any length of time. You have to have a non-disclosure, prohibitions of the seller negotiating or entering any new deals while you're negotiating. Contingencies are extremely important. I can't buy this unless I get financing. You have a lease, but it ends at a year. I got to have an extension or revision, and the landlord has to consent. The bank has to consent, all these types of things. Many of the items in the letter of intent are non-binding. However, the items that are binding are the provision that I will not go to your clients that I find out. I will not try to steal your employees and things like that. Next slide. Oh, there it is. Now, the structure of the transaction is either a stock or a membership interest if it's an LLC sale, or if it's an asset, it's the purchase of certain assets and maybe the assumption of certain liabilities. There are three main items that decide whether you do a stock sale or an asset sale: taxes, liabilities, and goodwill. Goodwill, I'll start with that first. If you buy a company that has a good reputation, you want to keep the name, you can still do that. You can buy the name if you buy assets. Liabilities is a huge thing. What do you do about assuming liabilities? If you buy the stock or the membership interest in an LLC or stock in a corporation, you buy everything that's in there, including tax liabilities that might go back 5 years, monies that's owed to banks, lawsuits that might be formed later on for something wrong, a liability went wrong with the product that you produced. So you've got to protect very carefully about that. On an asset sale, you pick and choose your assets, and usually the liabilities don't go with them unless the liability is attached, like a security interest to a car or a piece of machinery or what have you. There are several exceptions to that, however. I practiced in New York State for 50 years, and New York State, I think, is unique. But in New York, if the seller was obliged to collect sales tax, and unless you get a consent from the sales tax division that the sale is okay without any sales tax being paid, the buyer remains responsible for any unpaid sales tax. In the latest section on PPP loans, if the person that you're buying a business from has taken a PP loan from the government, I understand, I haven't been through it yet, but I understand that that loan is responsibility of the buyer unless the government waives it or lets you out of it. The other thing that you get is, add to the other in the agreement, is a covenant not to compete. That's extremely important, and it's a good way to transfer monies by making it taxable as ordinary income to the seller and deductible by the buyer. That can also be the same in a consulting and employment agreement. So that covers those three things. Next slide. What the buyer typically wants, and this is why you want to make sure you don't have a conflict of interest with your professionals. The buyer wants the ability to depreciate assets. They can only do that if they buy the assets. So buyer typically wants to buy assets. They want to deduct ordinary business expenses. So if they buy an asset, they buy a truck and it's worth $10,000, they can depreciate that over the proper time. If they buy the corporation or the LLC and it's already been deducted, they can't deduct it. The deductions are finished. They want to utilize previous tax losses, if any. I've seen people buy a business for no other reason that they had huge tax losses that they're able to offset against their own personal gains. And they also want to be assured that they're indemnified from all prior liabilities of the seller. Next, what the seller wants is capital gains. And if they sell assets that they depreciated, there's a recapture provision. That's why you need a good accountant to tell you that. They want as much money as possible up front. They want security for any future payments, and they want to make sure that any future liabilities that they're incurred after the closing don't happen. I had one situation, and I wasn't involved in it, but it was in our town, where a lawyer had sold his business that his father left him, and the bank who had financed the previous debt also loaned money to the new buyer. The buyer went bankrupt, and it turns out that the bank had a guarantee of all corporate debts signed by the seller personally. So he went to the seller, and he was forced to pay because he didn't realize that he had left his personal guarantee with the bank. Next slide.
Okay, thanks, Mike. This is a list of some things a buyer will look at, and I'll quickly go over them. They're all important. Sales trends, income, revenue, time that the business has been owned, 3 years as a minimum, profit and loss statements, tax returns. Yes, a seller does have to turn over his tax returns when you're deep into this process, and all financial statements. They all have to be in really good shape. A list of accounts receivable, equipment, intellectual property, pending litigation, past litigation, present litigation, liens, taxes, employees, key agreements with key employees, intellectual property, licenses, and the like. And these will not be a part of every transaction, but it's a good starting point, because when they are applicable, you definitely want to be able to get your hands on that information. There's also intangibles that aren't on this list, particularly business reputation, any local recognition that the business has received, best of awards, small business of the year awards, and that sort of thing. Next slide. Now, on the previous slide, you saw, I think, 12 different items which you would want to be able to look at in examining closely a business's operations and its potential for you as a buyer. But in the due diligence process, working with the advisors that Mike had talked about, your team, every one of those 12 boxes and more can fit into one of these 3 slots: financial, operations, or legal. So don't let this laundry list of topics put you off. This is basically the nuts and bolts of what you're looking at in approaching a transaction: financial, operations, and legal. Next slide. Okay, in accounting or financial due diligence, we've listed a couple of examples: financial statements, balance sheet, interim reports, letters from the company's auditors, inventory, and a testing of accounts receivables and accounts payable. But the thing is, what you probably don't pick up on when you look at this list is the verbs that start most of the sentences: review, validate, review, obtain, confirm, test. So that's what due diligence is. It's not just getting a financial report and say, thank you very much. You've got to do something with it. And that takes work, and usually the expertise of a professional, typically in the financial world, that would be your accountant. Okay, next slide. In operations due diligence, it's a little bit more broad-based and a little bit more variable, whereas doing due diligence on inventory or an income statement is pretty straightforward. Here, it can vary, your operational due diligence, depending upon the type of business that you're dealing with. And like I said before, this is not cookie cutter. So if you look just at the center, for example, where it says identify the risks, I'll just shoot down a couple of points there where it says concentration of customers. You know, everybody wants big customers. Everybody would say the bigger the better. But there's a risk. There's a risk in having a book of business which is identified by big customers as opposed to a book of business which is categorized by having a whole bunch of smaller customers. If you have 10 big customers and that is your business and you lose 3 of them, you may not make it through the next year. I mean, you've just lost, all things being equal, 30% of your revenue. So it's the same thing with every one of these customers and sales trends. What can go wrong? What can go wrong? What's happened to the sales trend just in the last month or quarter, not just over the last 5 years? Supply chain, we've seen that up close and personal in the pandemic, and companies that were able to get around this, pivot, change their business model a little bit, were able to survive, but some didn't. Next slide. Mike?
Unmute, yeah. Now, legal due diligence, exceptionally very important. These are things that you have to review and make sure you're getting exactly what you think you're getting. First, again, we talk about income and sales tax returns. You got to make sure they've all been properly filed and had no audits or anything that you could find. The next very important thing is review of leases. Not only real estate leases, but you got leases of equipment and other types of things, computers, all these things could be leased. And you got to make sure that either they're assignable or if they need the consent of whoever is the lessor, make sure you can get that consent. Real estate title, you got to review, if they own the real estate, make sure that's reviewed to make sure they have good legal title, and check if there's any liens against them, any outstanding judgments, things like that. Next, you've got to check to see if there are any employment, consulting, or non-compete agreements between the seller and any of their employees or past owners or past employees, and check those to see if they're going to be valid and good in what you need. Bank loan documents are extremely important with mortgages to see what permissions are necessary or whether they're actually transferable. Intellectual properties, they consist of things like patents and trademarks. Make sure they're proper, the business relies on them. You have to make sure that those are properly filed and see when their expires and whether they're really what you think they are. Check open sales and purchase orders. Are you obliged to enter into some things, either purchases or sales that aren't appropriate because maybe they entered into them knowing that they were selling the business and knowing that you'd be stuck with them. Also, you have to do UCC searches to make sure there's no security interest. Very often we used to find them there, but they'd been paid off. So you go back to the person who held it and try to get them released before you close. Next slide.
Okay. So, was that you, Mike? I'm sorry.
Yes?
I think I'm next, Mike. Thanks. So what happens after due diligence? And, you know, some of you that own businesses are sitting out there saying, I don't have to share all this stuff. Well, why would I have to give this up? I just want to sell the business. Well, the reason you have to participate in due diligence, both as a buyer and a seller, is because you're trading value for value. If you're selling your business, you're saying to the buyer, give me money, and I'll give you my business, which is worth this much money. It's not a confederate business. It's an honest, legitimate thing that you can buy and do something with. And that's very important, that you understand that you should not be offended by questions. If I'm going to give you money, you're going to answer my questions or I'm walking. And if you have an attitude that I'm not going to participate in this, I'm not going to do all this stuff, you're going to be one of those 80% that never sell anything. You can't get one without the other. So the buyer has to finalize all this necessary stuff many times just to get financing, just to get someone to lend them the money to do it. Now, a purchase and sale agreement is prepared once due diligence is finished. You don't agree to a deal until everything has been negotiated and signed. You have to make sure that all the exhibits are negotiated. You know, I talked about earlier about art on a wall. I participated in a transaction with a federal credit union that had bought a whole bunch of art. And when the guys came in for the merger, they expected to be able to buy the art. They hadn't checked it out, but that art was also under another title. And it wasn't included in it, and it skewed the whole thing differently. So you have to understand that everything has got to be included in that agreement. Now, closing occurs when all the exhibits and agreements are signed and the purchase price is paid. So if you don't keep this in store, if you don't keep planning on this, if you accept victory too quickly without realizing all the things that go wrong, you're putting yourself in for a great disappointment. Once you have signed the agreement, once you have that hot check deposited in your account, then you give a notice to your employees, suppliers, customers, and public, except for those you had to get approval from in the future of it. And then you have to establish any escrow and any security interests that are filed for who's going to purchase it. And you as a seller want to make sure that you aren't still on the hook for something. Most businesses, after due diligence, are sold with the buyer getting some kind of concession to carry the paper by the seller. And the seller typically signs a 3, 5, or 7-year deal. Now, all of this detail is you listen to what Mike went through and all the things that may be a danger to you. And you say, well, my lawyer will take care of it. Remember, your lawyer and your accountant do what? Cha-ching. They're charging you for those services. If you don't know where you're going, they're going to lead you in ways that maybe are not dishonest, but you're begging for them to charge you for services you don't understand. That's why we suggest strongly that you get yourself a mentor from our chapter or other chapters who has had experience in these kind of businesses, who's participated in these kind of transactions and understands where the trap doors are and can help you. They're not going to negotiate for you. They're not going to buy or sell the business for you. They're going to help you understand the complexity of going through this and what are the steps that you need to take to make sure that you're covered okay. So getting a mentor is very important. I think Dennis really addresses this well. Dennis, go ahead.
Sure, Peter. So really, it all boils down, this is like our summary page, how do you sell for maximum value? Well, key things are, as a takeaway, is that a business is worth more without you involved on day to day. So you need to basically work your way out of every job at some point, because chances are the buyer is not going to be interested in keeping you long term. They may want you there through an earnout phase to make sure there's a good transition. that the reins are passed in a positive way in terms of profitability. If your business is small and it's just you and maybe you have 1 or 2 employees, then we're basically looking at under the multiples of what they call SDE, and that's Stephen Dennis Edward, and that's seller's discretionary earnings. And what that means is you basically have a job that you're selling. So your multiple is going to be limited to 2 to 3, pretty much. And someone's buying a job with the salary. So that's kind of how that works. But the key is profits, free cash flow. So the business to be worth more, not only does it have to work well without you, but you have to increase the value to the highest level that you can. And why is that important? Because that'll help you get the most money when you multiply it by the multiple for your industry based on everything else that your business is doing. And as Peter said, SCORE mentors are free. And what we do, we kind of have a 2-step approach to this. One, you should just get a mentor anyway to help you improve the value of your business. And that, with the end in mind, they will bring in a exit strategy member such as Peter, Jory, Michael, or myself, or Larry. We have other ones. And to help work with your existing mentor in a co-mentorship relationship to help you guide your business along that path of growth and scaling till you're ready to sell. And then the baton might pass entirely at some point to the exit strategy member. So we're helping you really get out of the business in terms of what you're looking at, the different options, the different ways to get out, what makes the most sense for you. And that's very, very key. So the key is, again, building up the value of your business throughout your business life cycle with a SCORE mentor, and then combining that mentor with the exit strategist. Anyway, thank you all for coming today, and I pass this over to Diane.
You're muted, Diane.
Thank you. I love the applause. Hardly all heard that. I did not put that on, but I'm sure that was all of you who were still with us, who are thanking our amazing team for their insight into buying, selling, or exiting a business. I'd like to reinforce that on our Minnesota SCORE website, we have amazing resources available to you. You can volunteer. You may find that you are in business and have some knowledge that you'd like to share with clients. So if you'd like to volunteer, that's great. If you want to find a mentor, you can click on Find a Mentor. You can take workshops like this one. We have workshops all the time, at least once a week. We have podcasts and business scorecard articles that are stored. Those are from Dennis, and they are very informative, as well as templates, tools, and more online resources. You'll be getting a survey in the next few days. It would be really great if you could take a moment to fill it out. Most important part of that is, what can we improve and what other topics are you interested in? So without further ado, we have a couple of questions. If you guys would, I think you've all unmuted yourself, great. So Michael says, what are the well-known and not so well-known websites we can search to see what businesses are available to buy in our vertical?
I would say start with bizbuysell.com, and that's bizbuysell.com, and I'd start there.
Great, wonderful. I'm afraid, this is anonymous, I'm afraid if I tried to sell, a lot of fake buyers will approach just to get a hold of our information as a competitor, for example, who our suppliers are, pricing per product to get from manufacturers, etc. What can one do in this situation to prevent people from taking advantage of us or our business intelligence?
Well, you be prepared. You have to know what you're going to do. You have to understand the process. And until somebody, I mean, you have a right to check out that buyer before you even talk to them. And you have to have an idea of what their background is and have they run a business before, even to a point of making sure that they have the money. In the real estate business, a lot of real estate agents and brokers won't even show a property unless you have a mortgage lined up. So why would this be any exception to that? But if you're willing to let somebody walk in the door and say, I'll give you $100,000 for your money, walk out, then you're not prepared. You really don't understand the risk. You don't, everything we've talked about is just passed over your head. You have to get somebody to work with you to get going on this. And it should not be just your mother-in-law. It should be somebody who's had experience in this, and we have it at SCORE. And those are all the things that people look for. Mike, would you have a comment on that?
No, I
did.
agree.
Yeah, I had one more comment. I have found that typically the tire kickers, there really aren't a lot of them. That really is not something that happens very frequently. I won't say it never happens, but it's really not something to be concerned about. But as Peter said, if you check out your prospective buyer, that's key.
Okay, another question from Anonymous. Is
Can I
there,
just add a point there?
oh,
Diane?
sorry, Mike.
It seems to me that you're going to get anyone before you give them even the name of anybody, you're going to have them sign a non-disclosure agreement. The problem is, how enforceable is it? And is it really meaningful? I think you've got to discuss that with your lawyer and make sure that the person is honorable before they sign it.
Okay, is there a special process involved in transferring intellectual property, copyrights, trademarks, etc.? What are the final stages before official transfer of business from one party to the other?
Well, we'll start with the fact that there's due diligence. And in the due diligence process, you have to be able to validate everything that's out there. Mike can speak more specifically in reference to intellectual property on it. Mike, why don't you touch on that?
It depends upon whether you're buying and selling assets or entity. If you're selling entity and buying entity, those go along with the entity, so that General Motors has their patents and they go with whoever buys it. So that happens. If you're selling assets, I'm not a patent or a trademark lawyer, but you've got to go and probably get an assignment of that before, at the closing. That's one of the documents that you're going to have. Same way with motor vehicles. If you buy a trucking company, each of those is separately licensed. If you buy the entity, you've got them because they're already licensed. If you buy the assets, you're going to have to transfer each and every title.
One more question. What are the most appropriate ways to save money as the seller or buyer of a business? In what ways should we maybe spend extra, maybe not skimp? And in what aspects could we maybe consider cutting costs or going with the cheaper options from the start to finish of the sell or buy process? This is a loaded question.
Well,
I'm not sure I understand the question clearly. But if you're talking about saving money in the transaction itself.
Well, I think what Anonymous is asking is, so should you save a little money on a lawyer and pay a little bit more to an accountant? Is there a place that you can skimp?
I don't
think you really can answer. I can't answer that question because you want to do your own due diligence on the financial advisor, the legal advisor, and any other professional who's guiding you through this process. You know, you're spending $5,000 on bad legal advice. It's not a bargain if another attorney can provide you with a lot of expertise and save you from a catastrophe, and he charges a little bit more. So you really have to do the due diligence on the professionals that are going to be guiding you, just as you would when you get down to the closing table. You would have done your due diligence on all of the factors that we had discussed in terms of examining operations and financial and legal.
I heard
So-
that question differently, Jory. Maybe I'm wrong, but I thought they were asking that, what could I do as a business owner to either cut cost, to make my business more valuable? Are there any areas that you recommend I cut cost? That's the way I took it. And if that was the question, I'd like to answer it. And I think what you want to do is look at all your expenses, and you want to sort them from high to low. And you want to say, what can we do to cut expenses this next year? Do we really need to spend this amount in advertising, or this amount in manufacturing, or whatever the category is? And then just systematically go through, and then month by month, quarter by quarter, annually, see how you've succeeded, set goals, try to cut things if you can, try to improve your revenues and decrease costs, and that'll make your business more valuable. That's if you had asked a question that way. And I saw another, Diane, someone asked about free cash flow. Is it 1 year?
Well,
Are you going to ask that one?
Well,
Can I answer
when you
the last
stop talking, when you guys all stop answering the previous, I'll get to the next. Yeah.
Okay.
Can I answer?
Questions keep coming in. Go ahead, Mike.
We found in our practice that we earn more money trying to correct mistakes that were made by incompetent or cheaper people than we made in the deal. We would have made if we had charged in the deal. I would suggest that you never skimp on either the attorney or the accountant to make sure you get the exact proper advice and know exactly what you're doing. To bail
Okay.
you out after that is going to cost you a lot more.
It's
Okay,
a
we're
very
gonna-
good question, Diane, if I could just interrupt for a second. This is the question that drives everybody crazy. And if you're going to start working on showing your business, walk around your business with your mother-in-law and let her ask all the questions about your business without anybody there. You might have to wash the windows in your place. There's all kinds of things that you need to do to make it attractive to anybody's look. If you've got, I've walked through places that have garbage on the floor, and you're trying to sell your business for $100,000, $500,000, $1 million, and you can't even pick up the garbage. Those are the kind of things that you have to become aware of. And you have to also, as Dennis said very eloquently, you have got to trim up your balance sheet and your income statement. You've got to start treating yourself like an employee and not like the Queen of England. You've got to be able to get your costs under control. So when you do have due diligence, when somebody does look at your financials, you have an actual positive earning position
Okay,
to be able
Pete.
to present.
A good viewpoint. I thank you. We're really running over. It's 1:20 now. I've got 4 questions. Let's see if we can answer these quickly. What tools and databases can we use to conduct research on prospective buyers or sellers?
Talk to your mentor. They have a whole list of those. Well, that's not suitable for right here.
Great. Since the last year has been plagued with supply chain problems, COVID slowdowns of revenue, while expenses stayed high, would potential buyers understand this, or do we have to wait until financials have improved?
They would understand.
Okay. Is there a funding source for purchasing a business?
Yeah,
It's the buyer.
financial institutions and the
SBA.
seller sometimes will offer financing, deferred payments, SBA, a bunch
Okay.
of sources.
And talk to your mentor, right?
And
Right.
friends and family too.
The friends and family. They may not be friends and family long though. All right. This is the last question. One more question came in, but we really are running on low on time. I'm operating under a cottage law at the moment. I have a business owner approached me to sell my product in their restaurant, and they offered for me to use their commercial kitchen to make the product so I can get my food license. Is this a good idea? And is there a way to protect myself so they cannot copy my product?
Absolutely. You have to have a very well-drawn agreement. You've got to see a very qualified attorney who can help you along those lines.
All right. The following question is not regarding real estate. If we want to consider buying a certain kind of business and are open to buying outside our locale, even in other parts of the country, because we want to be one of the highest rates of returns. Thoughts about where to source deals above and beyond biz buy sell.
Biz buy sell has got a national reach.
Right.
So that'd be certainly a place to start, at least to get some idea of what's out there and prices, and relate the prices to location and sales value. You can sort of build your own spreadsheet around that. It's a good place to start.
Okay.
Most brokers have a website themselves or have a list of what businesses they represent. So go into an area and look for business brokers, and you may be able to find some things that way too. People also advertise them in all kinds of different places. You see them on Craigslist, for heaven's sake.
Yeah.
So yeah, you just have to search.
Absolutely. Absolutely, sir. That's what the internet is all about. Well, gentlemen, wonderful information. And thank you so much for sharing it with us. And I think the one message that you could leave everyone with is contact SCORE and get a mentor. And one of these fine gentlemen may be helping you with your exit strategy. Thank you all for coming. I'm going to end the meeting now. Thank you. Bye-bye.